Welcome, everyone, and thanks for joining us for iCM's first quarter 2026 quarterly market insights presentation. I'm Mike Paciotti, iCM's Chief Investment Officer. I'll be joined shortly by our Director of Investments, Ryan Lehman, and we'll be your host for today's presentation. 2025 was an excellent year for investors. While just about all major asset classes did very well, ironically, it wasn't the US leading the way. Both developed markets international stocks and emerging market stocks handily outpaced the US, with foreign developed stocks gaining 31% and emerging market stocks gaining 34% versus a not too shabby 18% for US large cap equities. US investment grade bonds also turned in a solid year, gaining 7%, bringing the 3-year total for that conservative anchor to most portfolios to 4.6%. Now, outside of the US, it paid to be price conscious. By focusing on undervalued foreign names in the developed world, you would have gained 42% in 2025. Not so for US investors, where gains continue to be more robust for growth stocks, which gained 19% versus 16 for their value counterparts. AI and the AI trade were still very much in vogue, with companies like Nvidia, Palantir, Alphabet, and Broadcom all having phenomenal years. Now, AI and the AI trade is a bit of a double-edged sword, both presenting life-altering potential and risk. So getting the most from AI from an economic perspective really requires a lot of things to go right. So this is really our theme for this quarter's Market Insights presentation. That is to explore and evaluate the impact AI has had on both the current and future state of financial markets. Now, for my part, I'm going to stick to mainly economics and fixed income before turning it over to Ryan to cover equities and real assets, along with the impact AI is having specifically on equity markets. So we have a lot to talk about, so let's jump right into things with some basic economic data, which relates to the broader AI picture and theme. So let me kick us off with the punchline, and then we'll drill down into some of the details. After averaging 2.7-ish% real GDP growth for really the last 3 years, and posting a somewhat humble 1.9% growth rate to end 2024, real economic growth was actually quite strong in 2025, growing at an annualized rate of 4.3% as of the most recent Q3, and with, of course, the first estimate on Q4 coming on January 29th. So to put this in perspective, this is nearly double the average of the last 20 years, and is a level many believe is unrealistic for a mature economy like ours to achieve outside of really recoveries from crisis like we saw post-COVID, when the economy reopened after really shutting down for a period. So looking a bit deeper, in contrast to the first quarter and second quarter prints, where CapEx was definitely the driver, the robust growth that we saw during the quarter was more about a reinvigorated consumer, along with a strong contribution from net exports, accounting for about 4% of the 4.3% growth rate. But despite this, the story in 2025 will be one of CapEx largely driven by the AI spend. Now, continuing this economic strength will be a bit of a chicken and an egg sort of relationship with CapEx. When the economy is good, capital is readily available, and the desire to spend on CapEx is strong. So this fuels further economic growth and is a big driver of both booms and busts. Now, the other key element from a broad economic perspective is inflation, and also relates to capital availability. So inflation, as of the most recent print, does remain above the Fed's target of 2%, but has basically flatlined at just below 3%, a key psychological level in our view. So flat to declining inflation will allow the Fed to reduce rates modestly and or keep them stable. Now, our view is not for any meaningful change in rates in 2026, which we'll get into in a bit. But stable rates at lower levels do provide some inflation relief in owner's equivalent rent, which is a key part of what's actually been driving inflation. So additionally, lower energy prices as well as greater availability of workers in labor markets should keep wage pressure low. So the key part of stable lower inflation is that the Fed can resist tightening, which would be restrictive to capital flows that have been supporting growth and capex. Now, the second part of the Fed's dual mandate, labor, lies in stark contrast to the picture of overall economic strength we've seen so far, and is quite different than the labor market picture we've seen over the last few years. So here we can see U3 unemployment, which is the official unemployment rate of the BLS. After bottoming in April of 2023, unemployment has ticked up from the low of about 3.4% to about 4.6% as of the November reading. Now, a good part of that has occurred since June, with a jump of about 60 basis points, really demonstrating the weakness that the Fed is responding to via the lower path of rates. Now, the orange line is the 3-month average of non-farm payrolls, or the number of jobs being added or subtracted real time. And what we can see is that payroll growth has essentially slowed to zero. While the overall economy is strong, labor paints a very different picture than capital. The picture here is rather bleak at the moment. Now, in stark contrast to labor markets, capex has really been the engine that's propelled the economy forward for much of 2025. This slide actually speaks to that very point. In most economic circles, it's pretty common to assume that the consumer spending in particular, represents about 2/3 of all economic growth. So this was certainly the case that we saw on the GDP slide. And if you go back over time, consumer spending would be consistently the largest contributor to real GDP. However, consumer spending is a reasonably stable number regardless of economic environment, as people need to provide for basic necessities regardless of whether we're in an expansion or in a recession. What typically drives booms and busts is capex, or capital expenditures by business. So as we can see here, since the mid 1990s, capex has become a larger and larger part of our economic pie, accounting for about 16% of GDP as of the end of the third quarter, versus just 5% back in 1995. Now, much of this spend, recently at least, has been on AI or AI-related infrastructure, electrical productions, buildings to house data centers, and so on and so forth. In the short term, this can support economic growth amidst labor market weakness. If that weakness is part of a larger theme, either from aging populations and less workers available or reverse immigration, growth of the labor force is likely to be a drag on economic growth. So it's important that productivity growth step in to fill that gap, provided that it in and of itself doesn't displace labor. But for the moment, with readily available capital, we really see no reason that capex shouldn't continue in 2026. Now, speaking of the Fed, all the conflicting data that we've been talking about makes their job even harder than it has been over the last number of years. So as of the December meeting, the consensus had been for between 2 to 3 rate cuts in 2026, probably a realistic estimate in a normally functioning economy. No, meaning really no unforeseen shock. So in fact, with the economy remaining strong and many on the Fed believing that we are actually approaching neutral, I would err on the side of expecting less. So while rate cuts to support labor markets are the traditional remedy, it's certainly debatable on whether monetary policy is even the right tool for this, or if this is something structural. So our expectation is for rates to settle for a time near or just below current levels. If at that point the Fed indicates that we're at neutral, we believe that this may actually result and some flattening of the curve by bringing long rates down at least modestly. So let's shift gears to fixed income. 2025 was a very good year, as we talked about in the intro, for fixed income investors, with all major fixed income assets benefiting from a broad reduction in rates and credit sensitive segments additionally benefiting from the strong economic backdrop and risk on appetite. So for the year, emerging markets local currency debt, a longtime favorite of ours and mainstay in our portfolios, gained nearly 20%, outpacing the Bloomberg Ag by 12 percentage points, and actually outpacing the S&P 500 for that matter by over 100 basis points. So this was driven by above average coupons and by general weakness in the dollar. So we'll get into that in a little bit greater detail in just a few slides. Now, domestically, U.S. high yield bonds led the way, gaining nearly 9%. This was driven mainly by coupon clipping, as spreads, despite a roller coaster ride, managed to fall a modest 20 basis points during the year, but really remained near historical tights. Now, investment grade credit also turned in a solid year, gaining 7.83%, while the broader U.S. bond market gained 7.3%. Munis were the laggards this year, gaining about 425 basis points in investment grade space and a modest 2.4% in high yield space. So let's start with treasuries. As we saw in the last slide, treasuries were a strong performer in 2025, but a modest laggard at a broad level to the Bloomberg Ag. So the reason is subtle, but partly visible here. So this slide shows curve steepness of the 10-2 segment of the curve versus the entirety of the curve, the 30-2 segment. In both cases, we can see that the curve has been on a somewhat prolonged steepening path, with the depth of flatness inversion coming somewhere around June of 2023. Since then, the curve has been steepening as it continued to do so in 2025. In fact, the 10-2 segment steepened by 35 basis points in 2025, while the overall curve steepened by about 80 basis points, meaning 2-year rates fell more than 10-year rates, which fell more than 30-year rates. So the fact that most of the rates movement was at the short end of the curve, treasuries did not benefit fully from the duration impact that a parallel shift might have provided in 2025. So the other takeaway here is that while the front end of the curve has yet to really return to average steepness, the overall curve, particularly the back end, has, right? So this may lead to some additional tactical opportunities with the long bond as the year progresses. So this next slide speaks to corporate credit markets, specifically high yield. As I mentioned on the performance update slide, high yield bonds had a really strong year that was mainly attributable to coupon clipping, with some modest spread narrowing, 19 basis points contributing around the edges. As a result, spreads now rest at basically the lowest levels that we've seen since 2005 and again in 2007, where they reached similar levels of tightness. Now, from here, and looking at the graph, the longer term path of spreads is quite clearly wider. However, with the economy expected to be strong and an abundance of capital, it would seem that any disruption to credit would likely have to come from within markets or from tangential markets like bank loans or private credit, where overall credit quality and new lending has actually been quite suspect. So for us, there's little reward in 2026 beyond coupon clipping, but similarly, little risk from within the high yield market, as corporate credit quality is actually quite good. Contagion and repricing of risk is really the primary risk we see for 2026. Now, let me spend a minute or two talking on some of the risks and some of the threats that we see, As I mentioned a minute ago, traditional public fixed income markets up and down the credit quality spectrum actually appear to be in pretty good shape, with overall balance sheet strength and corresponding credit quality being stronger than is typical for a corresponding rating. Now, some of the tangential markets, as I mentioned, specifically public bank loans as well as private credit, are a rather different story. Now, this slide here shows the overall growth of private credit from 2002 through 2024, with some of the late phase exponential growth that has occurred recently not even represented here. So, since 2018, private credit has grown from just shy of 600 billion to a 1.4 trillion dollar marketplace, with some estimates expecting year-end 2025 AUM to reach 2.5 trillion dollars. So not surprisingly though, given the popularity of the asset and the demand for private debt funds by consumers, lenders in the latter portion of 2025 really began relaxing lending standards and reaching lower in credit quality than is typical of the space, something eerily reminiscent of the relaxed lending standards that occurred during the housing crisis, with some estimating that the traditional single B, double B rating of private credit is overstated by as much as 2 full ratings. Now, since capital remains fairly easy to come by, if there is to be a pullback in lending by investors or a repricing of this risk, we suspect it will likely be as a result of a single issue or a series of highly spectacular defaults, much like that well-publicized BlackRock Renovo issue that we saw a month or two ago. Now, related to this, AI has been one of the more aggressive beneficiaries of capital from private credit. So this, along with traditional vendor finance, has boosted earnings and allowed for a tremendous wave of CapEx spending, both directly within as well as in AI adjacent industries. Now, Oracle remains the most exposed that we've seen, with over $300 billion in vendor finance commitments linked to OpenAI alone, representing roughly 60% of their total market cap. Now, OpenAI has committed a total of $1.4 trillion in contractual commitments against a $4 billion revenue stream. So the canary in the coal mine, as it would seem, might be OpenAI, but some large investment grade players, Oracle in particular, might be holding the biggest bags. So this is reflected in the massive surge in Oracle credit default swap spreads, or protection from creditors in the event that Oracle should default. So needless to say, there are certainly some signs of speculative excess and even the links forming of contagion that are really starting to become apparent. And then just to wrap up with emerging markets bonds, which are one of the few areas outside of core bonds that look attractive today, they experienced some pretty outsized performance this year after a pretty difficult Q4 last year. And despite rising by more than 19% on a year-to-date basis, we still feel that there's room to run here. And there's really two reasons for that. First, while spreads may not look overly attractive versus US bonds, with a yield on the index of around 6-ish%, you're still earning, healthy premium over the Bloomberg Ag and over US Treasuries. So in addition, a key contributor to performance this year has been the weakness of the US dollar. But despite that weakness, we still view the dollar as meaningfully overvalued versus the basket of emerging markets currencies, with the possibility of contributing around 2% to total returns over the next cycle. So you stack these two components on top of one another, and you're really looking at the potential for annualized returns in and around 8% compared to expectations of about 4 to 5% for U.S. investment grade bonds. So that concludes my remarks on the economy and fixed income. Ryan will take you through equities and real assets. Ryan?
Yeah, Great. Yep. So thanks, Mike. Let's switch over and talk about equities here for a bit. So equities shook off some early tariff-related fears to rally more than 40% from their April lows. This left the S&P 500 with a 2025 return that was just shy of 18%, so pretty healthy returns. However, performance wasn't necessarily widespread, so we definitely continue to see some signs of an overly concentrated and a highly valued market. So just to quantify that, we had nearly 40% of the S&P 500's members actually finishing the year in negative territory, and we also had just 8 stocks accounting for half of its total return. Now, from a style standpoint, growth stocks did continue to lead value in 2025, but that margin was less than 3%. So really at the end of the day, investors saw pretty strong returns from both their growth and their value holdings. Now, gains were even more impressive overseas, where non-US developed value stocks advanced by more than 42%. We also saw emerging market stocks gain over 33%. Both of these are quoted in US dollar terms. And unlike their US counterparts, gains here were generally widespread. So if we looked across the entire non-US equity space, you would have seen roughly 75% of names actually ending the year in positive territory. Now, just thinking about the contributors here, so non-US stocks benefited from a number of fundamental tailwinds in 2025. This is going to include newly announced fiscal stimulus plans, improving economics, as well as a weaker dollar. And if we look at what the dollar did last year, it fell or weakened by about 10% versus the basket of developed currencies. And then lastly on this slide, I just wanted to hit on commodities. Broad basket commodities did produce attractive absolute returns in 2025. They did trail U.S. large caps but by a very small margin, just 2%. Returns here, they were largely supported by some pretty unprecedented price gains in precious metals. So we had gold rising by more than 60%, and silver prices actually soaring by nearly 150% in 2025. And if we look at last year, it was really a kind of a perfect storm for precious metals investors. You had geopolitical uncertainty, central bank buying, particularly in gold, and then also a supply-demand imbalance, which sent gold and silver prices to record highs. Now, conversely, energy investors, they did see losses across most major commodity contracts with supply concerns and falling demand weighing on prices. And this was particularly true for crude oil as well as natural gas. Now, I wanted to start off my section of the presentation talking about some risks to U.S. stocks. And I alluded to this already. The market as a whole is pretty highly valued today, but this is largely a result of the index being concentrated in highly valued tech stocks. So for instance, if we look at just the trailing 12-month PE for the index, that was around 27 times at the end of the year, which is well above just about any long-term average you might look at. But this is going to be really skewed by just really a handful of AI-related tech stocks. So at year end, we had NVIDIA trading at 47 times last year's earnings. We had Broadcom trading at 65 times. And then we had Alphabet, Amazon, Apple, and Microsoft all trading at just about 35 times their trailing 12 months earnings. And just as troubling is the price to sales ratio for the index, which here we have data going back to the late 1990s. We're currently trading at an index price to sales ratio of around 3.5x. This is the highest level that we've seen really in the last 25 years or so. And in addition, you're going to find that more than 20% of the index is actually trading at a price to sales ratio of more than 10 times, which is going to be a clear indication of speculation and pretty extreme overvaluation for a handful of those names. Now, here's the conundrum we currently find ourselves in. So yes, valuations are high, but earnings growth, that's been strong. And like Mike alluded to already, expected capex spending also expected to be pretty strong, and this is expected to continue at least into 2026. So the question is, what's the potential risk here? Where do we see the greatest risk to these names outside of just the fact that they're expensive? And Mike did talk about this a little bit when he discussed private credit earlier. So I wanted to touch on what's called circular or vendor financing. That's what you're going to see in this slide, which is a little bit confusing because there's a lot going on. But what essentially vendor financing is, it's contracts between both private and public entities to purchase each other's products in exchange for investment or ownership stake. And in this case, it revolves around major publicly traded tech companies and then private AI companies like OpenAI and Anthropic. So let's take the Oracle relationship as an example because they have gotten a lot of negative headlines recently. So what Oracle has done is they've agreed to build and operate this massive data center infrastructure for OpenAI. And then once that build out is complete, OpenAI is committed to pay Oracle for their services. And this contract has an estimated value of right around $300 billion. Now, to fund this, Oracle's borrowed pretty heavily based on the expectation that OpenAI is going to pay them something like $60 billion per year to use the infrastructure. And Oracle's ability to borrow these funds is essentially based on these future revenues. Now, here's the risk. OpenAI only had revenue of around $10 to $15 billion in 2025 as an estimate. If all of this expected AI spend doesn't actually materialize, if companies start to pull back on CapEx, OpenAI doesn't have the funds to satisfy their commitments. And now Oracle is essentially saddled with this debt and a potential $300 billion gap in expected revenue. And the same is true for many of the other relationships on this chart. So it's very similar. We think back to the kind of the late 1990s, early 2000s, very similar to the fiber optic cable build out during that time period. And if we think back to that period as well, the internet did eventually change the way that we live and do business in a very substantial way. But markets just got a bit ahead of themselves in terms of pricing this in and the valuations investors are willing to pay for the stocks related to that internet build out. So the question is, what does all this mean from an investment standpoint? Well, the implications aren't great, especially with US markets broadly trading at high valuations. But thinking about two recent periods where we had expensive stocks followed by market drawdowns, today looks a lot more like 2000 than it does 2022. And that's a big positive. So if you think back to 2022, there was essentially nowhere to hide. Stocks were expensive, bonds were expensive, and the only assets during that period that had positive returns, cash and commodities, essentially. 2000 was much different and more like our current situation. So if we think about bonds look pretty attractive today with pretty attractive starting yields. And like Mike said, the longer end of the curve, intermediate term bonds, very attractive today. But outside of large growth stocks, we also have a good number of assets that look very attractive, especially on a relative basis. So even if we do see a sell-off in tech or the bursting of the proverbial AI bubble, it doesn't necessarily mean you need to earn subpar returns in a diversified portfolio. Just look at the post-2000 period as an example. Value stocks, small caps, and emerging markets all entered that period at pretty attractive valuation levels. And despite large growth stocks falling by 25% from 2000 to 2007, value stocks gained 75%, small caps gained 68%, and EM stocks actually soared by 274%. So there are clearly opportunities out there, and a number of them look really appealing today. So let's take a look at a few of those assets, those appealing asset classes in greater detail. So if we start out with value stocks, and in particular quality deep value stocks, relative valuations are trading at some of their most attractive levels on record. And this is compared to both extreme growth stocks and what we're going to call shallow value names. And from a historical standpoint, this is really only rivaled by late 2021, and then also that peak that we saw right before the technology bubble bursted. We also see strong fundamentals here. Not only do these names provide investors with an enhanced level of income over traditional growth names, but we're also seeing a slowdown potentially in earnings growth expectations for growth stocks, while earnings growth for value names is actually expected to accelerate. So here you've got an asset class that is near historically cheap in terms of valuations, and then it also shows the potential for improving fundamentals. Next, we've got small caps. So here we've seen massive underperformance for much of the last decade plus, but honestly, that's not too surprising. So valuations entered the most recent period, that big drawdown where I have the red line drawn on the chart, at very expensive levels. And then in addition to that, they also really felt the pain of higher interest rates more so than large cap stocks just over the last couple of years. And this has resulted in essentially a near full reversal of that valuation story, with small caps now pretty much trading close to on par with large caps. And in addition, the earnings growth story here is also very positive. So coming off of some pretty depressed levels, Bloomberg currently estimates around 50% earnings per share growth for small caps in 2026 compared to 13% for the S&P 500. And then if we look out to 2027, estimates are 26% for the small cap index and again just 13% for the S&P. Now that said, though, if we do hit a rough patch for equities, you may see some additional downside here because small caps do tend to be higher beta. But in any type of recovery, or if markets do continue to hold up, there is a lot to like about this asset class. And that's something we haven't said in quite some time now. Then lastly, we've got non-US value stocks, which we feel could actually weather any type of AI-driven storm better than most US assets. There's a number of reasons for that. So first, there's just a general lack of AI exposure. Now, you do get some in the emerging world, particularly as you look at Korea and China, but that does diminish pretty quickly when you start to look at the value side of the market. Second, we've got near historically cheap valuations on both a relative and an absolute basis. And then lastly, again, we see improving fundamentals from an economic and earnings growth standpoint. And this is due to a lot of the factors that we've discussed in prior market updates, such as expanded fiscal and monetary stimulus programs. And these are some of the things that really help to propel these markets higher in 2025. And then just to wrap up this section, one thing I did want to touch on was the dollar, because it was a huge tailwind for non-US stocks in 2025. After being a pretty meaningful headwind for much of the last decade or so. If we were to just look at kind of a tale of two markets, the dollar strengthened by between 6 and 7% versus non-US currencies in 2024. That completely reversed itself in 2025 with that uncertainty around tariffs, as well as uncertainty around fiscal and monetary policy in the US, really caused the dollar to sink. So we saw a weakening of 9.8% versus the EFA basket of currencies, and then a much more modest 2% versus the EM basket. And just one note I wanted to make here, when Mike talked about emerging markets debt, we did see a much larger contribution to EM debt returns in 2025. The equity and the bond indexes, they are much different from a country and currency standpoint, in particular in regards to their weights. So if we look at the equity index, Korea and China are a much larger component of that index, which did hold back some currency gains. But the big point I did want to make here is that we feel this could be the beginning of a long-term reversal and not just a short-term trend. If you look at the chart on the right, we're plotting PPP valuations for the dollar versus the Dixie basket of currencies. And what you're going to see is a really strong positive relationship. And from where we stand today, at about 30% undervalued for non-US currencies, the dollar really has the potential to weaken pretty substantially over the coming cycle. Now let's talk a bit about real assets and alternatives. So in terms of commodities, it wasn't necessarily a great year for the energy sector, but precious metals prices did soar, which helped propel the index higher. We saw gold prices increase by more than 60%, while silver prices more than doubled, advancing nearly 150%. These were the strongest annual gains that we've actually seen for gold and silver, going all the way back to 1979. And this was really just a fundamental story for both. So gold benefited from lower interest rates in the US, as well as an uptick in geopolitical uncertainty and then an increase in global central bank demand. Silver, on the other hand, that saw a boost from a large supply deficit. And then in addition to that, increased demand due to its actual use cases in AI applications like semiconductors and data center buildouts. Now, despite these gains, looking ahead, commodities do continue to appear attractive. We currently have an expected return expectation of just under 8% annually over the next 10 years. Now, that is below the long-term average return that investors have gotten for US stocks. But given the current valuation environment, our expectation for US stocks is well below that over the next decade, somewhere in the kind of the low single digits. So not only do commodities offer a nice diversification benefit potentially, but also the potential for excess returns as we look ahead. And then we'll just finish up here with closed-end funds. So discounts did narrow a bit throughout the year, but it was very much so an asset class by asset class story. So we saw the most significant narrowing in non-US stocks and munis. So international stock funds, they largely benefited from increased investor demand due to those strong NAV returns, while municipal bond discounts narrowed as investors became less concerned about rising interest rate risk within the US. Now, taxable bonds is where we actually saw some widening, which is kind of counter to what we've seen over the last few years. And despite credit spreads narrowing a bit throughout the year and ending the year near all-time tights, it looks like investors were just becoming a little bit wary of how tight the discount environment had become in the taxable bond space. Now, on a positive, though, what this did do is it did create some selective buying opportunities for us, especially later in the year. Now, if we look at the universe as a whole, closed-end funds, they do sit a little cheaper than average at around 5% below NAV. And as a result, if we look at the universe, not necessarily flush with opportunities right now, but for tactical managers like ourselves, there are still some really nice selective opportunities to be had at pretty attractive discounts to NAV. And then just to tie everything together, let's go ahead and walk through our asset class forecasts and then some strategy positioning. So starting with our long-term return expectations, order here is not changed, but we have seen a reduction in return expectations given the strong results in 2025, not necessarily on a quarter-over-quarter basis, but more so on a year-over-year basis. So most notably, if we look within the US, you've got large cap stocks with an expected return of just around 2% annually over the next 10 years, with large growth stocks expected to provide essentially flat returns over the next decade. This is largely the result of those lofty valuations. And then if we look within the US, quality value, small caps, they essentially look to be the best houses in a so-called bad neighborhood. And as we'll see momentarily, we do continue to maintain overweight positions to value and quality in our strategies. And we also recently increased our allocation to small caps. Then if we look to the right-hand side of the slide, you're going to see some really standout opportunities for non-US equities. So we've got non-US developed stocks at 9%, EM at 16%. And this comes despite that strong outperformance that we saw in 2025. The big driver of this differential is kind of what we talked about throughout the presentation. Valuations look attractive. The currency's there to potentially add an additional tailwind. Both of these are going to favor U.S. stocks as we look out or potentially favor U.S. stocks as we look out over the long term. And then in addition, we don't have it on the slide here, but those return opportunities, they look even more attractive if we were to look at the value side of the market. And then all of this, everything we talked about today, that's going to directly tie into our strategy positioning. So we've got a pretty sizable underweight to U.S. stocks. And within the U.S., our most meaningful tactical position is going to be an overweight to U.S. value. And in particular, in those attractively valued, deeper value, higher quality names. Outside of the U.S., we have a meaningful overweight in both international and EM value, as well as that out of benchmark position in commodities. The major change here has been a slight increase to small caps on the US side and the additional REITs that occurred in Q3. And then on the fixed income side of the equation, no change to our allocation to emerging markets debt, like Mike talked about, still looks really attractive there. But we did recently, now this was in Q3, we did adjust our positioning and sector exposure within our core allocation. So most notably, we normalized our yield curve exposure, which neutralized the duration of our treasury portfolio. This was done along with that small cap change in, I believe it was early September. And then previously, we were favoring the shorter end of the curve, shorter term bonds, which did work out pretty well for us over the last few years. In addition to that change, we also cut our corporate credit exposure essentially in half, and that's due to those historically compressed nature of the current spread environment and the fact that we just don't see much upside and risks being really skewed to the downside in corporate credit. So with that, that's going to do it for this quarter's Market Insights. If you enjoyed the presentation, please feel free to like, share, and subscribe. Also, if you have any questions or would like to learn more about our product offerings, please feel free to reach out to a member of our advisor services team. You can see all of our contact info on this slide as well as our website address. Thanks for watching, and I hope everyone will join us again next quarter.